I just want to introduce Jim. Jim is great. We love Jim working with. We've worked fairly closely with him over the years. Find my Zoom window. There we are. Jim is the founder and CEO of Easy Legal Planning, which is, if you're local to the Utah area, is a local company, online estate planning, specializing mainly in revocable living trusts. But Jim, you've had a lot of extensive experience in the estate planning world, so very familiar on all things estate planning. If I'm not mistaken, you created Easy Legal Planning because you recognize an opportunity that everyone needs an estate plan, but not all of them are efficient and affordable. And so that's kind of where your expertise lies. And I guess lastly, if you're not assisting clients, you're either on the golf course or spending time with family, right?
True. That is absolutely true with that. That's that well said.
Wonderful. Well, I'm going to turn it right over to you, Jim. If you have questions for Jim or myself or my colleague Chad, feel free to drop them in the Q&A. I will be monitoring that, and we'll try and keep this to 30 minutes or so, and then allow for as many questions as we need to following.
Okay, that
Jim?
sounds fantastic. Well, thank you, Rocky. I so appreciate it, and thank you for the intro on that. And just for the listeners that are here, kind of going a little bit more in depth along those lines of the story. So I started working in an estate planning law firm, early 2000s, so about 24-ish years ago. Hence all the gray hair here. Oh my goodness, with that. But I noticed something that kept happening over and over is the client would come in, they'd sit down, they wanted to get their estate planning done and they needed to get it done. But when they got quoted the price, they ended up walking right back out the door. And I was like, you guys, this is a pricing thing. Like if you gave these guys a deal, they would totally do it. And the attorney said, well, true, but the problem is if we give them a deal, then they're going to tell their friends and family, and we're going to have to give them a deal, and then we're going to devalue the product and shoot ourselves in the foot. So, not going to do it. And I said, okay, fair enough. And then I got thinking, and I was like, well, there's got to be a better way to do this and do it more cost effectively. And so I said, well, what if we did something where we did more of like an educational approach, and then all you guys had to do is draft documents and make sure that everything is done the proper way, and that way it's not taking any of your time to do anything other than just make sure the docs are correct. And they're like, well, yeah, we can totally do that, but nobody's going to do it that way. And again, keep in mind, this was the early 2000s, so the internet was not what the internet is today. But anyhow, because of our price point, it just kind of took off. And then, fast forward, we now do this in all 50 states. So that's another great thing is we're set up and all of our documents are state specific, attorney drafted for all, so for all of your listeners, whatever state that you're in, we can help out, and your docs will be state specific and attorney drafted for your state. But we do everything in flat fees. So our fees are just static across the board. So it doesn't matter what state you live in, we just keep the same prices. So anyhow, it works with that. So that was really kind of how this kind of got kicked off with doing that. But let's kind of jump feet first in to probably the most common question that we get every single day. And Rocky, if you wouldn't mind, click that next button for me there. This is the big question that people ask is they say, what's the difference between a will and a trust? And there's a lot of information out there, a lot of misinformation out there, a lot of questions revolving around trusts and wills. And so I like to try to keep things as easy and simple as possible. And I'm going to try to do my best today to accomplish that as well. Flip over to the next one, if you wouldn't mind there, Rocky. And this is really and truly probably the most important concept that I want every single one of you that is on this webinar today to understand this. Everything in the estate planning world revolves around your signature. Now, what I mean by that is right now, while you're alive, you can do whatever you want with any of your property and assets because you can sign on the dotted line. So whether you want to deposit money, withdraw money, invest your money, buy a house, sell a house, refinance, again, you can do whatever you want because you can sign on that dotted line. However, where a lot of people don't connect the dots is if heaven forbid something happens and you pass away and you don't have any estate planning done, just remember when you die, your signature dies with you. And that's what creates all the problems because now if your kids or family went and tried to sell your house, the title company goes, family, I hate to tell you this, but mom and dad are the only ones that are listed as owners of this house. And since they're dead, they can't sign and transfer this over to you. You're going to have to go to court so that the court can step in to represent mom and dad. Now, flip to the next screen there if you wouldn't mind on that as well. And then we're going to talk just a little bit about how wills work. But I wanted to give you kind of a quick little understanding. We're going to talk about probate in just a second here. But when you set up a will, And most people know this. When you set up a will, really you're doing three important things. Number one, you're naming your executor, or in other words, who's going to execute or carry out your wishes. Number two, you're naming beneficiaries. In other words, where's your money going to go when you pass away? And then if you have minor children, you're naming guardians that would step in to get custody. And those are really important decisions. And so that's why a lot of people go, hey, I want to set up a will, and that'll take care of our executors, beneficiaries, and guardians. So that way, if we pass away, all is well. And then people ask and they go, um, will that avoid, the probate and all the issues? And the answer, unfortunately, is no. So even if you have a will that maps out exactly how you want things to go and names your executors and beneficiaries and guardians, it still ends up having to go to court and go through probate. And a lot of people ask and they go, why? Why is that? Why would a will have to go to court and go through probate if it outlines exactly what I want? And the answer is because a will takes effect after death. And remember, after death, you've already lost your signature. So I put this into context for people and I say, okay, so think of it like this. Let's say that you and your spouse are joint tenants on the title of your home, because that's very common between spouses. Or if it's an individual and you're not married, you're just on the title of the property. Well, let's say that you have this beautifully written will that outlines exactly how you want things to go when you pass away. Well, here's the problem. The will doesn't do anything until you die. But remember, as soon as you pass away, that's when the will takes effect. But here's the problem. You're still on the title of the house. So if all of a sudden your executor goes and tries to sell the house, the title company goes, executor, I can't even talk to you. You're not on the title of this property. We're only authorized to talk to the owners of this property. And since they're dead, we can't talk to you. So you're gonna have to go to court. And so the court can step in to represent the deceased people. And then we can start to chat and you'll be able to sell the house and carry out their wishes. But a lot of people don't totally connect those dots. So just remember, wills are documents that take effect when you die. And when you're dead, you've already lost your signature. And if you can't sign and transfer those assets, it has to go to court and go through that probate process. So let me have you flip over to the next screen there really quickly there, Rocky, if you wouldn't mind. Okay, and really, I probably should have had this up as I was giving that example there, but basically, this is kind of an example of some, parents passing away and the kids stepping in and trying to sell the property. And basically the title company says, sorry, you can't sell this property. You're not on the title. They end up having to go to court and go through probate. And it just takes time and money and effort. Not that probate's the end of the world, because it's not, but it does take time, money, and effort to go through that, which is not very much fun. So then people ask and they go, well, how do we avoid this? I always thought that if I had a will, that's how we would avoid probate because it maps out how we want things to go when we die. But people think about it and they go, but after learning about that it all revolves around our signatures and wills take effect when we're dead, and after we're dead, we've lost our signatures, they go, okay, that makes sense. And they go, but is there a way to avoid it? And the answer is yes. And I'm gonna have you click to the next slide there as well. And the way that we can avoid the probate is by setting up a revocable living trust. And now the knee-jerk reaction, a lot of times when we say, hey, you can avoid probate by setting up a trust, the knee-jerk reaction is, I've always heard that trusts are for multi-millionaires, like crazy rich people. And that's another big misconception. Trusts are not just for the uber wealthy. They're used all the time in very simple situations. And people ask and they go, well, how does a trust work? Like, what would we be doing if we set up a trust? And the answer surprises people because believe it or not, when you set up a trust, you're doing the same three things that you do when you set up a will. You're appointing who's going to control the money when you pass away, where's the money going to go, and who gets custody of any minor children. And so then people scratch their heads and they go, well, what's the difference then? It sounds like the trust is identical to the will because we're mapping out how we want things to go. What's the difference? Well, the difference is this. As soon as you sign a trust in front of a notary, the trust becomes a living entity. That's why they're called living trusts. And most people, they go, what does that even mean? What's a living entity? I have no idea what that even means. Well, there's two things that I always like to teach people about living entities, and hopefully this will make sense to everybody. The first thing that you have to understand about a living entity is living entities can own property and assets, just like a human can. So when you set up a trust and it becomes this living entity, it can own real estate, it could own bank accounts, it could be named as a beneficiary, like on life insurance or retirement. Now, I'm going to have you flip to the next screen here because I'm going to kind of do a little bit of a visual here. So think of when you set up a trust, Think of like you're purchasing this big empty safe and you have the key or the combination to that safe. So while you're alive, you can open the safe, you can close the safe, meaning you can put assets in or you can take assets out. You're in full control of everything. Click to the next screen if you wouldn't mind for me there, Rocky. So just remember the idea of the trust is while you're alive, it can own property and assets. So while you have your signature, because you're still alive, we set up a trust that outlines how you want things to go when you pass away. And then while you're still alive, we use that signature to transfer your house and your bank accounts and life insurance or retirement and get those assets transferred into the trust. And then you maintain full control of the trust. So remember, you still have the key or the combination to the trust. So if you want to put more assets into it or sell a house or remove something, again, you're in full control. You can do whatever you want. Move to the next slide for me if you wouldn't mind there. But when the time comes that you pass away, so whether it's you as an individual or you and your spouse both pass away, really all that's happening, and I'm gonna have you click to the next one as well, is all that's happening is you're giving that key or combination to your successor trustee, which is kind of like your executor. And then your executor now has to follow the rules that you've set in the, stated in the trust. So and I'm gonna have you click to the next one. Sorry, have you keep clicking on here. So basically the person that you've named to carry out your wishes, they now have to follow the rules of your trust. So they can control when, where, and how that money gets distributed. And maybe you don't want your kids getting the money until they're a little bit more financially responsible. That's really neat. You can do that in a trust. Whereas in a will, as soon as your kids turn 18 years old, they get the money lump sum. And a lot of parents go, oh man, I remember when I was 18. If I got a lump sum of money, probably wouldn't have spent that very wisely. And so that's some of the neat things about the trust is you can put age restrictions or put limitations on what the money can be used for, or maybe you just want it to be used for college education until they reach 25. And then when they've got a little more life experience under their belt, then they can get the rest of their inheritance. So those are some of the neat things about the trust. But just remember, going back to those two things. So when you set up a trust, it becomes this living entity as soon as it's signed and notarized. And remember, the two things is because it's a living entity, it can own property and assets just like a human can. So you're essentially using your signature to move and transfer your property and assets into the trust. And then the second thing is when the time comes that you pass away, the trust doesn't die. Because it's a living entity, it continues to live. And that's how your successor trustee is able to just step in and follow your wishes. Because there's nothing for the court to transfer. There's no need to probate the house. The house has already been transferred into the trust because you put it there. Same thing with bank accounts and life. There's no reason to probate those. All those have already been transferred and attached to the trust, and you did that while you were alive. So that's how we're able to avoid the probate and make things super simple and straightforward is by setting up that trust, which is going to allow you to map out how you want things to go and who's going to be in control and so on and so forth. But remember, the most important and critical part is while you're alive and you have that signature, use that signature and start moving and transferring assets into that. Now, let's talk a little bit about what assets go into a trust, because that's probably, you guys maybe, I know you can see on the screen here of going, okay, a house, an IRA, 401k, bank accounts, and people go, how do you do that? Like, what needs to happen to get those assets moved over into the trust? Is it hard? Is it expensive? Like what's entailed in that process? Now, there are seven, I'm going to put my fingers up, seven categories of assets that go into a trust. First is real estate. We're going to talk about that. Second would be bank accounts, brokerage accounts, life insurance, retirement, personal property, that is like cars or personal effects, couch, furniture, jewelry, anything that's on the inside of the home, and then business assets like an LLC or a corporation. So let's kind of go through those one by one and talk about how we move those assets into the trust after the trust has been signed and notarized. Now, the first and largest asset that most people have is their house. And like we talked about, most people, if it's an individual, they're going to be on the title of the house as the sole owner, or if it's a husband and wife, a lot of times they're both going to be on the title as joint tenants. And people go, well, how do we, in either of those situations, how do we get the property over into the trust? And the answer is by preparing and recording a deed at the county recorder's office, wherever that property is located. So people go, okay, so who prepares the deed? Well, you've got a couple of options. We can prepare the deed. A title company could prepare the deed. If somebody knew what they were doing, because people ask me that all the time, they're like, well, do I really need somebody else to prepare the deed for me? And the answer is technically, no, you could prepare your own deed, but probably not the best idea unless you're super, super familiar, because you do not want to mess up the title of your property or the legal description and run into issues there. So that's why it's important to have somebody that is really familiar with deeds and how to transfer them, prepare that so that it doesn't run into problems with doing that. So, whether we do it or a title company does it or whatever the case may be, a deed is prepared and then it's signed by you guys as the owner of that property, and then that deed gets recorded at the county recorder's office. Now, if we prepare the deed, we give you an envelope that's already stamped and ready to go, and then all you do is sign the deed in front of a notary, fold it up, and put it in the envelope that we give you, and you drop it in your mailbox and mail it into the county. They'll record the deed and send it back. So very simple with doing that. But that's how you transfer real estate into the trust, is by recording a deed. Now, some people ask this question and they go, what if I had multiple properties and they were in different states? Like, do I need to set up a separate trust for each property because it's in a different state? And the answer is no. So you would have your trust established in the state that you reside in and that you pay taxes in, but it can own property in any of the 50 states. So essentially, it's the same thing. We just prepare a deed. It gets signed by you in front of a notary, and then it gets mailed into the county recorder wherever that property is located, and then they'll record the deed and send it back with that. So very straightforward. Now, sometimes people ask and they go, "What if I own property out of the country?" Well, unfortunately, every country has their own rules. And so you would really have to communicate with really probably an attorney or the equivalent of a title company in that country to see if you're able to attach that to a United States trust, or you may have to create some type of a will or a trust that their country requires. So unfortunately, I don't know exactly the answer just because every country is a little bit different on that one. But for the United States, if you have property in any of the 50 states, then we can certainly prepare deeds and get those transferred over into the trust. Now, another question that people ask is they go, what about if I have a mortgage? If I have a loan on my property, do I need to do anything with the lender? Do I need to like refinance or update my loan or something like that? And the answer is no. If you've got a loan on that property and you transfer the title over into your trust and it's going to remain as your primary residence, again, you don't have to do anything. You just keep making your mortgage payment, business as usual, and there's no issues along those lines. And so that's a big question that we a lot of times get, because people are worried. They're like, I still have a loan or a mortgage on my property. Am I able to set up a trust and move the title into the trust? And the answer is yes, with doing that. So that's how real estate is transferred. Oh, excuse me. Another question that people ask is they go, what if we set up a trust, we transfer our house into the trust, and then a few years from now we decide that we want to sell? Are we going to run into problems trying to sell our house if it's in a trust? And the answer again is no, because you're still on the title. You're just no longer husband and wife as joint tenants or individual owning it solely. You're listed as the acting trustee of your trust. So as the acting trustee, you have the full authority to sell it or refi or borrow it. You can do whatever you want, just like you can right now. But the key thing that you have to remember is if you sell the house, it automatically comes out of the trust. You don't have to do anything differently. You don't have to call us. We don't have to update anything. You just sell it and it comes out of the trust. But if you take the proceeds from the sale of that property and you go buy another property, that does not automatically just go into the trust. So like if you don't say anything to the title company when you're buying a new property, they will put you back on the title either as an individual or husband and wife as joint tenants, because that's kind of their default. So it's super important that if you sell your home, it comes out of the trust. But when you buy another home, don't forget to tell the title company that you have a trust, and they will title it in the name of the trust right from the get-go. And that way, it makes it super easy. It doesn't cost anymore. You don't have to update anything. You don't have to call us. Just tell the title company, and they'll take care of that right from the start. So, and I know that we'll open this up for questions. So if any of you guys have questions revolving around real estate, we'll talk about that more. But that covers one. The first thing was real estate and how we transfer that into the trust. The second asset that goes in the trust would be bank accounts. Now, I'm talking about personal checking and savings account. So not a business account, but like a personal checking and savings account. And people go, well, I have a bank and a credit union that I belong to, and I have a checking and savings account at both of those. How do I get those into the trust? And the answer is you have two options. Option number one is you can leave the account in your name or names if it's a jointly owned account. So just leave it in your names, business as usual. So that way, the way you deposit money and withdraw money and your credit cards and the way you write checks, again, all that stays exactly the same. but all you're updating is the beneficiary designation. Now, typically a bank or a credit union will call it a POD. That stands for payable on death. Sometimes they'll say pod. Who's your pod? And most people are like, what in the world is a pod? That just is an acronym for payable on death. But it's basically a beneficiary designation. So you literally would just name the trust as the payable on death. So that way, while you're alive, the functionality of your checking and savings account, business as usual. But if you die, the bank now goes, oh, we're now supposed to release the money to the trust. So that's probably the easiest thing to do. The second option is you can change the ownership of your checking and savings account to name your trust as the owner. So you could go into your bank and say, hey, I just got done setting up a trust. I want my trust to be the owner of this checking and savings account. And they'll switch the ownership. Now, that does take a little bit more effort to do that, and your checks will change, and sometimes they'll give you a brand new account number. So for people that have auto pay or auto draft set up on their personal checking and savings account, that takes a little bit more legwork because then you kind of have to redo all of that. And so that's why a lot of people go, I'm just going to keep it in our names, business as usual, name the trust as the payable on death and call it good, which is fine. So that's how you handle bank accounts. Now, the third asset that goes into the trust would be a brokerage account. So that would be like, Charles Schwab, Morgan Stanley, again, any type of broker that you're working with. And again, it comes down to those exact same two options. So if you have a brokerage account, and sometimes when I say brokerage account, people go, oh yeah, I have an IRA. And I'm like, well, that could be handled under a broker, but that is a retirement account, which is handled a little bit differently. A brokerage account is typically with after-tax dollars, and so we're not worried about like triggering a taxable event on that. So that's why it goes back to those same two options: is you can leave the brokerage account in your name and then just name the trust as the beneficiary. Now, technically, most brokers call it a TOD or a TOD. That stands for transfer on death. So very similar to a payable on death, or you just call it a transfer on death. So that way the account stays in your name, business as usual while you're alive, but if you pass away, it transfers upon your death to the trust. Or same thing as we talked about with bank accounts, is you could go into your broker and update the ownership, and then the trust becomes the owner of that. So again, either option with brokerage accounts, because we're not dealing with taxable events. We will talk about retirement accounts and how that works, but that's the third asset. The fourth asset that goes into the trust would be retirement, or excuse me, I skipped over life insurance. I got thinking about the retirement accounts and said that. So the fourth is life insurance. And so this could be term insurance or whole life or a variable life or really whatever type of life insurance that you have. Now, there's a few different options with life insurance. You can change a primary beneficiary. You could leave your spouse as the primary, name the trust as the secondary. You could change the ownership of the policy to name your trust. So you can kind of do any of those things because we're not dealing with taxable events. Now, what most people will do is if they're single, they'll just leave the policy in their personal name and then they'll name the trust as the beneficiary. Now, if you're married, a lot of times people go, well, I've already named my spouse as the primary beneficiary, so I'm just going to leave my spouse as the primary, and then I'll name my trust as the secondary. Now, an exception to that rule might be you might have a second or a subsequent marriage where you don't want to commingle everything and you don't want 100% of your life insurance going to your spouse because you want to give some to your kids from a previous marriage or relationship. And so in that scenario, again, you could name the trust as a primary beneficiary, and then there's some rules that outline in the trust that, hey, not everything's going to my spouse. Some of this is going to be going to my kids or other beneficiaries. So there's some different ways that you can go about handling that. Now, I'm going to talk about this right now. I was going to talk about this in just a second, but I feel like this might be a good place to talk about this. People go, what if I already have my children named as the secondary beneficiaries, whether it's my bank account or life insurance or whatever type of an asset that I have? I've got my spouse as the primary and I've already named my children as the secondary beneficiaries. Can't I just leave them as the secondary beneficiaries, or does it make more sense to change the beneficiary to name the trust? And the answer typically is it makes more sense to name the trust as the beneficiary. And people go, well, why? And the answer is, well, a lot of times parents don't understand that if they name minor children as secondary beneficiaries, or a child with a disability, or a child that's just not good with money, that can create a big problem. We see this all the time where we have young families that are like, hey, I have a life insurance policy. I've named my spouse as the primary, and then I've named, my three kids as the secondary beneficiaries, each receiving 1/3. And we're like, okay, great. Well, how old are your kids? And they're like, oh, well, they're still young. They're 5 and 8 and 10. And I'm like, well, you realize that if you and your spouse both passed away, a life insurance company, they can't release money to a minor. They can't do it. And so then it's going to have to go to court, and they're going to have to appoint a guardian and a conservator to now manage that money. And then as soon as your kids turn 18, they're going to get it. And that creates its own, other set of rules. And so by having the trust as that secondary beneficiary instead of the kids, well, now if husband and or both spouses pass away, now the money pays out to the trust, and then the trust is going to say, "This is who we've appointed to manage this money for our kids." And oh, by the way, we don't want our kids to get the money until they turn 25 or 30 or whatever the parents feel comfortable with, on doing that. And then you've got somebody that can pay for college or schooling or braces or clothes. I mean, the money is absolutely there to raise and care for your children. It's just they don't get free reign over the money until they reach whatever age or ages that the trust stipulates. So, for that reason, that's why we like the trust to be the secondary beneficiary, because that way, if you've got a minor child or a disabled child, it's not going to create any problems. Now, the other thing is people go, well, I don't have any minor children and I don't have any disabled children. So, should I still name the trust as that secondary beneficiary, or if you're single, as the primary? And the answer is yes. And they go, well, why? And the answer is because kids are human and they can pass away. And I know that sounds so absolutely brutal and harsh when I say it like that. But let's say that we have a husband and wife and they've named each other as the primary beneficiary, and then they've got their three children as the secondary. And then let's say they're all adults. Well, let's just say that one of those kids got in an accident and passed away. And now all of a sudden, mom and dad forget to update the beneficiary designation, so it still reflects all three kids as the secondary beneficiaries. And then mom and dad pass away. Well, the surviving two kids are going to reach out to the financial institution and say, "Hey, financial institution, mom and dad died. We're the beneficiaries, the two of us. We needed to release the money to us." And the financial institution is going to go, "Wait, hold the boat here. Why are there only two of you? We've got three secondary beneficiaries, you each receiving one third. We can give you one third, you one third. Where's your sibling that's supposed to get the other third?" And they're going to say, "Oh, well, they passed away before mom and dad." And they're going to say, "Hate to tell you this, but mom and dad never let us know. We don't know what we're supposed to do with that one third. We don't know if it's supposed to go to the two of you, or if it's supposed to go to grandchildren, or what we're supposed to do. So you're going to have to go to court and let the judge decide through probate." So for those reasons, we go, let's not mess with that. Just remove humans as those secondary beneficiaries, name the trust, and then the trust is going to outline all the contingencies. And the trust will say, okay, divide the money three ways. And if one of my kids passes away and they have children, their one third goes on to the grandkids. But if I have a child that doesn't have any grandchildren, then their one third goes back to the other two. So you can kind of do whatever you want, but that's the advantage of the trust, is we can build in those contingencies so that it doesn't create a problem down the road, something that you're just not really anticipating. So anyhow, sorry, I know that was a little bit of a tangent, but some of you might have been thinking like, why are we naming the trust as the secondary beneficiary? I've already got my kids named. So hopefully that helps explain a little bit why we like to do it that way. Now, the fifth asset that goes into the trust is retirement accounts. Now, this one is really, really, really important to understand, because there's a lot of misinformation out there on the interwebs that have a lot of conflicting information, where sometimes people are like, never, ever, ever put your retirement into a trust. Well, I agree if you said do not ever transfer the ownership of a retirement account. Because if you had, like, let's say I had an IRA or a 401k, and that money, I've never paid taxes on, that's money growing tax deferred. And then I got a trust and I was like, hey, financial institution, I need to change the ownership out of my name to name my trust. That would create a taxable event. That would be horrible. And so you absolutely would not want to do that, because again, that creates a big taxable event problem. So we never change ownership on retirement accounts because of that tax consequence. But if you are unmarried, an individual, then you can name the trust as the primary beneficiary for all the reasons that we've talked about. So that way, if you pass away, the money pays out to the trust, and the trust sets forth the rules, and it has all the contingencies. Now, if you're married, a lot of times spouses will name their spouse as the primary beneficiary. So that way, if one spouse dies, the surviving spouse gets a rollover. So they can then roll that money over into their own policy and continue to defer the taxes. And then they don't have to start pulling out the required minimum distributions until the IRS says, hey, you're 73. Whether you want to or not, you're pulling this money out, on doing that. So that's what we typically do with retirement. So ownership always stays in your individual name. Spouse is typically going to be the primary beneficiary, and then the trust becomes the contingent or the secondary. And we, in all of our trusts, we have all the new Secure Act language. Now, some of you may go, I don't even know what that is. We're not going to go into the details of that today. We'll save that for another time. But the Secure Act is just some new laws that were passed in 2018 on how retirement accounts can get distributed to trusts. And so essentially, it allows your beneficiaries to pull the money out as if they were named as the beneficiary on the policy. So they can either pull it out lump sum, that's option one, and pay all the taxes, or they can pull it out using the required minimum distributions over 10 years. So the trust gives the beneficiaries of the trust those same two options, which is nice with that. So that's the fifth asset. Now, the sixth asset that goes in the trust would be personal property. So that would be cars, furniture, jewelry, paintings, clothing, like literally anything that's on the inside of your home or garage is considered personal property. And what we do is we prepare a document that you sign in front of a notary. And as soon as you sign that document, it automatically transfers all of your personal property to the trust. So you don't need to go to the Department of Motor Vehicles and change the title of your cars. The cars stay in your name, insurance stays in your names. The trust is just simply you've assigned your interest. Assign just means transfer. So whenever I say assign or assignment, that just means you're transferring that asset to the trust. And so we prepared that assignment of personal property, which really just transfers all of your personal possessions. And that takes into account anything that you currently own that's movable or anything that you may acquire down the road. So if you bought a new car 2 years from now or a used car, just buy it in your name and insure it in your name, business as usual, because the assignment already made that part of the trust. And sometimes people go, well, what if I bought a new TV at Best Buy? Do I need to tell them I have a trust? No, personal property is already part of your trust. Now, we do give you a separate document where you can handwrite specific items that you want going to specific people. And I always tell people, this is really, really, really important because most of the time the kids aren't going to fight over money because normally the parents go, hey, just divide the money evenly between the kids. So they're not going to fight over even. But what the kids will fight over is mom promised me the sewing machine, or dad promised me his guitar, or dad said I could have that gun. Those are the things that create cracks and divides and fights like you've never seen. And so we always encourage people, make sure that you address that ahead of time. And we give you, like I said, a separate document you can handwrite on so you guys can sit down as a family and say, okay, is there anything you're going to fight over? Let's address this right now. And then you can identify this item goes to this person and this one goes to that person. And so on and so forth. And anyhow, there's a few different ways of going about that, but that just helps to um, take out a lot of the fighting and quarreling that can happen over possessions. Now, the seventh and final asset that goes into the trust would be business interests. So that would be like an LLC or a corporation. So for those of you that own a business, and that could also be like a sole proprietorship as well, or an LLC that's a single member or a partnership or whatever. And the way that we transfer those into the trust is you have two options. Option number one is we can prepare what's called a business assignment. So if you already have an LLC or corporation that is already established and filed with the Secretary of State, and you're like, I don't want to have to go backwards and update all my, operating agreements and bylaws and all of that, then we can prepare what's called a business assignment. So you sign a document and it assigns your interest to the trust. So that way it makes it super easy, and that way if you pass away, your interest of the business is already part of your trust. Now, for people that have a trust and they're going to be setting up a new like LLC, you can actually name your trust as the owner or the member to that LLC right when you're setting up the LLC. And then that way, when you set up all of your operating agreement, your paperwork, it already has your trust named as the member. So if you pass away, whatever that LLC owns is now already part of the trust and gets distributed according to the rules and guidelines in the trust. So those are the 7 categories of assets. So again, bank accounts, brokerage accounts, life insurance, retirement, personal property, oh my gosh, that was so funny. Personal property, business assets, and then personal possessions as well. That was really funny. I had total brain cramp right there on doing that. But those are the assets that go into the trust. Now I'm going to have you flip over to the next one here, Rocky, if you wouldn't mind. Now, for some of you, a lot of people ask and they go, what if I already have a trust? Then I would say to yourself, do is it current? Have you funded it properly? Because we talk to people all the time. They're like, oh yeah, I had a trust drafted, 15, 20 years ago. And the first question we ask is we're like, did you transfer all of your assets into it? Is it properly funded? And most people go, what does that mean? What's funding? And then we'll say, well, in order for the trust to function properly, while you're alive, you have to either change ownership or beneficiary to name the trust. And most people are like, no, we've never done any of that. I thought because we had a trust, it avoided probate. And I'm like, no, not at all. That's a big misconception. So I'm like, if you have a trust and you haven't transferred any of your assets into the trust, it will absolutely still go through probate with doing that. So anyhow, if you do have that, oh, another question that people ask is they go, if I did have a trust that was drafted from somebody in a different state because we've moved or they're no longer practicing or whatever, can you guys help us with updating my current trust that I have? And the answer is yes. We can absolutely help to update an older trust that you have. We do what's called a restated amendment, and then it keeps the same name and the same date. So that way, any assets that you already have funded to that trust, we don't have to go backwards and change any of those, just leave everything in the name of the trust. But then we can restate the trust so that it's all 2025 compliant. If you've moved to a different state, it'll reference all the codes and statutes of that new state with new powers of attorney and everything that are state specific. So if you need help with an old trust, then we can certainly help on that one. Okay, click to the next one on there for me, and then we're going to go over some questions in just a second here on this. People ask and they go, what's included and what does it cost? So like I said, we do everything in straight flat fees. So we charge $6.95. Now, there is a $15 shipping, and so it's really $7.10. I don't like hidden surprises on anything, so I always just tell people, yes, it's $6.95, but there is a $15 shipping, so really it's $7.10 for the full trust package. But these are all the documents that are included. So it's your revocable trust. We do a declaration of trust. We do your assignment of personal property and your assignment of business interest if you have a business. We do what are called your funding documents. So those are the documents that identify bank accounts, brokerage accounts, life insurance, retirement. We have instruction letters that you can use and give to your financial institutions. And A, so Schedule A stands for assets. So literally it is a schedule of your assets where you will literally handwrite the names of all of your financial institutions so that if you pass away, your successor trustee slash executor is not going to be on a wild goose chase. They'll open up your binder to Schedule A, and then it will tell them exactly what banks you belong to and credit unions and life insurance or retirement, so they know who to reach out to. So that's Schedule A. We also do a certification of trust. We do last will and testament, which is technically, we call that a pour over will. And a lot of people, they go, wait a second. So if we do a trust, we're also going to be doing wills? And the answer is yes. And people go, why? I thought you just said that wills have to go through probate. And the answer is they do. And this is no different. So we do a pour over will so that just in case you accidentally forget to transfer one of your assets into the trust while you're alive, the will catches that like a safety net and then pours it over into the trust so that it follows the same age restrictions that you put in your trust. Because if you don't have a pour over will, like let's say we have a husband and wife, they set up a trust and they bought a new house and they forgot to deed the house into the trust. Well, when they die, the house is going to have to go to court and go through probate. Well, if there wasn't a pour over will, the judge would sell the house and give the money to the kids as soon as they turn 18 years old, because that's how it works in a will. But the pour over will says, judge, don't do that. We have some very specific ages of when, where, and how we want this money getting to our kids. So when the house sells, pour the money over into the trust so that our trustee can manage that money until our kids reach the stipulated ages. So that's why we do a pour over will, but it still has to go through probate and to court and all of that. It's a little bit quicker. It is a little bit of a quicker probate, but again, nonetheless, it still has to go through probate. Then we also do your financial powers of attorney. So that way, if you're incapacitated and you need somebody to step in and take over financially or legally and communicate with your banks or credit unions or pay bills or open mail, file taxes. Again, we've got the document that'll do that. And then we also do your healthcare directives and your living wills. So that way, if you're in the hospital and you're unconscious and you need somebody to make medical decisions or communicate with the doctors, we can, you've got the documents that'll handle that. We do burial and final instructions. So if you want to be buried or cremated. And then we also have instructions for all the key people that you name. So that way they know exactly what their responsibilities are. And we always encourage our clients, hey, give these instruction letters to the people that you've named so that they can read what their responsibilities are ahead of time. So that way it's not, they're not completely just caught off guard if there's an emergency. they know what to expect. And then the last thing you see at the very bottom there is just deed to transfer the title of real estate. So we charge $250 to prepare a deed. So if you have a home and we need to get that moved over into the trust, again, we charge $250 to prepare that deed. And then the county has a separate recording fee. So depending on what state you live in and what county you live in, there's a county recording fee to get that deed recorded. And like I said, either we can do that or a title company can do that, but you want to make sure that the deed is done the right way so that it doesn't get fouled up on that. But let's turn the time over, and I'm gonna have you click to the very last page because then it just has contact information on there. So that way, it has my name and my email address. So if you guys have got questions, you'll have that. But let's kind of open this up to questions. And Rocky, you've probably been monitoring, and people have probably been having questions coming in. I'm not seeing any of that. And so let's address any questions that come up for the next. How much time do we have?
So, well, we usually keep these to 30, 45 minutes with questions, but everybody, of course, if you need to jump off, feel free to jump off because we did get a few questions in. First of all, Jim, great content. Thank you for taking us over that. There's a lot when it comes to estate planning. So if anyone here has questions or anything we're not able to get to, definitely reach out to us. I'll put up our contact information as well. There's a lot to think through when it comes to estate planning. A couple questions. I did try and answer as many as I could as we were going. But first question is if my spouse and I are both on house paperwork before putting it into, or they chose not to put it into a trust, if one person dies, can the spouse act alone or will it still go through probate?
Great question. And the answer is if both spouses are on the title or listed on assets jointly and one spouse dies, it will automatically default to the surviving spouse. No court, no probate, no issues. Now, when the second spouse dies, that's when there would be an issue with doing that. And the only thing that I would say that you have to be, somewhat careful or prepared for is if one spouse dies and the property goes to the surviving spouse, if that surviving spouse decided to get remarried or decided to, hey, I don't really want the money going to whatever we had kind of talked about, they could make up their own plan and kind of change things at that point in time with doing that. So just be a little bit aware of that. And that's why a lot of times families like to do things while they're both alive so that they can make sure that they nail things down.
Perfect. Next question, which I love. This is a great question. I was going to ask it if nobody else did. If you have a child with a disability and they're like going to outlive you, talk us through that. What kind of a trust is it? Should we set up a trust for them? What do you recommend?
Absolutely. And I'm so glad that somebody asked that question as well. And the answer is yes. So, what we do is in your revocable trust, we build in what's called a special needs trust. So that way, while you're alive, whether it's an individual or husband and wife, you're still maintaining full control of all of your assets and so on and so forth. And you're caring for that child with special needs with your own care and assets. But if you pass away, we have this special needs trust that says, don't just give that money to that child with special needs because if they're receiving any type of state or government assistance, the state or government's going to go spend mom and dad's money first that you just got as an inheritance, and so they can kick them off those benefits, and then you have to reapply, and it's a pain in the rear end with doing that. And so when we have that language set up in the trust, then it says, okay, whatever amount or percentage that we want going to that child with special needs is now held in the special needs trust, managed by the trustee, and then that money is there to supplement. So it allows the state and government assistance to continue to pay out to that child. And then they've got this money in this special needs trust to supplement. So if they needed money for additional things above and beyond what were covered, they've got money and the trustee has access to that. And then the trustee is the one that essentially buys all of those things for the child with special needs. So the money doesn't transfer to the child with special needs and then they buy it. The trustee is overseeing and purchasing those things on behalf of that child.
Awesome. That's a really important topic. We run into that from a financial
Yeah,
plans aspect a lot, where there's not a trust in place and you absolutely 100% want one of those special needs trusts in place.
yeah, absolutely. Super question with that.
All right. Next question here. This is a fun one. Are pets considered personal property?
Great question on that. Interestingly enough, if you have pets, we very similar to like a special needs trust, we actually can add to your trust what's called a pet trust. Now, what you would do with the pet trust, that's if you want to set aside a certain amount of money and name somebody specifically to get, and I don't want to say guardianship because it's not like you're formally getting guardianship of a pet or an animal, but you can identify in your trust, hey, I have a pet trust. I'm going to set aside $15,000, $20,000, and this is the person that my pets are going to go to. And then there's money set aside to pay for those pets, so that's not it's not creating an issue for the person that you've asked to, to get your furry friends with that. So absolutely, we do those all the time.
Perfect. What if, in terms of business assets,
Mhm.
does business interest extend to 501c organizations?
Great question. And typically, no. A 501(c)(3) is a totally different animal, and they've got very different rules of how they go about and allow things to be taxed and allow things to be transferred. There are, I mean, some very complex ways that you potentially could assign or transfer your interest of a 501(c)(3) to a trust, but it's very difficult just because they've got that board of directors and there's a lot of things. We actually don't deal with 501(c)(3s because we do get that question where we're like, hey, I've got this, organization and nonprofit, and how does anyhow? But that's kind of its own separate animal. And when you structure those, you typically are structuring them with scenarios like, hey, what if one of these members passes away? What happens? And then there's ways to resolve that within the agreement itself.
And then along those same lines, if your business is a pass-through corporation like an S corp with little to no value, is it still important to assign it to the trust?
Yeah, and the reason why I'd say yes is if you even if you have like small things that business owns, or even like a bank account that owns a small amount of money that you're like, yeah, I just have a little bit of money that's sitting in this business account, and I haven't really done anything with it. Then it allows, by assigning it to the trust, then it allows your successor trustee to access that, even if it was $1,000. Because what we don't love to see is they're like, oh my gosh, I forgot to transfer that $1,000, and then they pass away, and then all of a sudden it's like, great, now it's got to go to court and go through probate. Well, it's going to be more than $1,000 to go through probate to try to get to that $1,000, and so it just that's why we would say yes. If you've got any type of a business, let's just assign it because it doesn't hurt anything to sign that document and say, hey, if I still have this when I die, it's part of the trust.
Perfect. Another question here. If we're going to sell our home soon, should we wait until after we sell that and to get the new home before putting it into the trust?
Super question. And the answer is yes. But ideally, you'd still want to set up the trust first so that when you sell your house and you buy the new house, you've got a place to put the new house. Because remember, if you wait to do everything, and all of a sudden you sell your house and you buy a new house, well, you're going to close on the property in your individual name or joint tenants. And then if you set up a trust after that, then you're going to have to pay us $250 or a title company to then transfer the title over into the trust. So ideally, you would set the trust up first. Don't transfer current house into the trust. Just leave that in your names. Sell that, and then when you buy the new property, tell the title company that you have a trust, and then they'll deed it into the trust right from the start.
And what about business partners? Does that complicate things?
No, nope. I was going to say, so because what happens with the business assignment is all it does is it transfers your interest of that business to the trust. So, like, let's say that I had a business partner and it was a 60-40 split and I owned 40%. Well, my business assignment is simply saying, hey, I'm taking my 40% interest of this business and moving it to my trust. And that way, if I passed away, my business partner couldn't be like, well, Jim died. I now own 100% of this business. It doesn't work like that. My trust still owns that 40%. And then they've got to figure out, they're either going to have to buy out my trust or my family or do something differently. But that's how it works. But it wouldn't affect anything. Doesn't affect anything tax wise because the trust and the LLCs are both pass through entities, and so taxes would be identical. So it's not going to do anything with the way you file taxes.
Perfect. All right, so maybe last question here, just for sake of time. Kind of two of them here. Jim, for your services, what is the cost in terms of updating, as opposed to just creating a new trust package, just updating the trust? And how long does the whole process take, beginning to finish, if you're setting up a new trust?
Super questions. Okay, so if you need to, like, let's say you had an old trust and you're like, this is really old, totally outdated, we need to redo everything. We would do what's called a restated amendment, and the price would be the exact same. So it'd be the 695. If you need help with deeds, it's 250. So price would be the exact same. So whether we're setting up a brand spanking new trust or we're doing a restated amendment to an old trust that we didn't initially start, the price is just the exact same. Now, let's say that you were working with us and then you needed to make an update. In that scenario, we charge between $200 and $400 to make changes. Most changes are $200, but if you needed to like update everything, because sometimes we have that, like people will set up a trust and then 5 years goes by and they're like, well, we need to change everything. Like the people that we named, we no longer want them to do anything or even be a part of our trust. So we need to redo everything, and that would be like a $400 change on doing that. So that's kind of cost wise, and hopefully that made sense. So just remember, if we've never worked with you before, whether we're doing a brand new trust or a restated amendment, it's the $695 plus the $15 shipping, and then the deed preparation if you need help with that. But if you are working with us and need an update, then it's $200 to $400 for changes down the road with that. And then the last question that you asked was just time frame wise, like what's the time frame? So we have an online questionnaire. We have a lot of really great videos that are on our website as well. So if any of you guys need a refresher, you go to the homepage. There's actually a picture of me right on there, and there's an interview on there that really kind of reiterates this conversation and goes into depth. So if any of you guys want refresher on what we talked about today. I mean, obviously you can come back to this video, but you can do that as well. And then on our website, it says once you're ready to go, click on the questionnaire and get started. You'll fill out the questionnaire, and we've made our questionnaire really simple, and we've done that intentionally. We used to have a really complex questionnaire, and I called it analysis paralysis. It gave people too many options and they froze. And so we made it really simple. But that's helpful for people. But once you've completed the questionnaire, then it takes us about 7 to 10 days to get all the documents drafted. So roughly about a week. And then once the documents are drafted, we email you a short summary so you can proofread everything before we actually print the hard copy. And then once we get your stamp of approval, after you've read through that short little summary, then we get all the documents printed. We put little sign here sticky tabs everywhere, and we mail them right to your doorstep. And that normally takes about 3 to 5 days for that process. So I typically tell somebody from the time you fill out the questionnaire to the time you have the documents in hand, it's usually about 2 weeks. Sometimes a little bit shorter than that, sometimes a little longer than that if you took a little bit longer to get back to us, but generally speaking, about 2 weeks.
Wonderful. Well, thank you, Jim. There's a couple questions we didn't get to. Feel free to reach out to us directly, either to Jim, Jim at Easy Legal Planning. I'm going to bring this back up as well. If you have more planning related questions, if you're wanting to look at, do I need a trust? Should I just look at a will? Obviously, we talked about the pros and cons of the trust, but feel free to reach out to us. We're happy to help. You can scan that QR code to schedule a meeting either with myself or any of our other team members here at GBS. And we're happy to be a resource for you. So thank you, Jim, for jumping on, going through all that great information.
Oh, thank you.
We still have a lot of people hanging on, so that tells us there was some good information.
Okay, well that's great with that, and we'll look forward. And again, please feel free. They can reach out to either of us, and we'll help to hammer through additional questions that we were unable to get to today. But thank you so much. I was going to say it was so fun to be there, and I'm sorry that I got a little long way. Usually I'm like 30 minutes, and then we get going, and that just we kept on keeping on keeping on, or whatever how that saying goes. But
Yeah, absolutely.
perfect. Is there anything else, Rocky, that you need from me?
Nope, not at the moment. Just
Hey.
feel free to join us on our next webinars if you want to listen in on some of these topics.
Would love it. Love it. That sounds fantastic. Thank you so much. And thank you, everybody. And we'll be in touch.
Okay, have a good day, everyone.
All right. Thanks so much.
Bye.